All right, so let's start our today webinar. All right, so basically, right, so today we'll be covering this topic is so-called how investor can prepare for a potential Federal Reserve rate pause in this tightening cycle. All right, so thank you for joining today's webinar. So I'm Nick, Relationship Manager from Toa Payoh branch. Okay, so basically for today, right, so we'll be split the topic into three different parts. Okay, so the very beginning, so we'll be covering the cooling inflation and impact on interest rate. Okay, so what we need to take note before investment. All right. So after that, so we'll be covering what happens. So when the Federal Reserve really were to cut the rate, so what happened to the equity market and also the bonds market. Okay. So and finally, so we'll be discuss about what's the investment option. Okay, so that available and potentially could be benefit from this rate cut. So this is how our today webinar structure. Right. So before we start our webinar, right? So we need to have a very brief understanding about this interest rate and also the inflation. All right. So basically, right, so what is inflation and what is interest rate? Okay, so we no need to understand too much, but basically we need to understand the relationship. Okay, so usually for interest rate, right, it's trying to move in the same direction as inflation, but with lags. Okay, so because interest rate are the primary tool used by the central bank to manage inflation. Okay, so meaning that, right, for this is very simple. So inflation will be the primary objective. Okay. So after that, right? So the interest rate will be the Federal Reserve, the central bank, the primary tools used to control. Okay. So the inflation. So meaning that when inflation goes up, right? So if let's say go too high, so the Federal Reserve or the central bank might increase the interest rate so to control the inflation. Okay, so basically this is the positive relationship between the inflation and the interest rate. All right. So basically this is a very brief understanding. Okay. So after that, right? So another things that another benchmark we need to know is Federal Reserve will try to target and control the inflation at about 2%. Okay. So basically this is their target. Okay. So after that, right? So what we need to know about will be basically the higher the inflation, right? So will be higher the interest rate. Because basically this is a lagging, so they need to control the inflation. So that's why they will increase the interest rate to control. Okay. So this is a three simple guideline we need to know. And ultimately, right? So this is what we're covering today. So what if the inflation falling and due to its economic slowdown? Okay, so after that, the central bank might cut the rate, right? So to stimulate the economics. Okay, so basically, right, so this is the part that we need to know. Okay, so not necessarily the Federal Reserve or the central bank, right, will to cut the rate will benefit the stock market. Okay, so or the economics. Because basically the Federal Reserve will to cut the rate, right? So meaning that is something happening. So that's why they need to do the prevention or to stimulate the economics. Okay, so basically, this is the simple guideline that we need to know so that we can discuss further later on. Okay, so basically, very simple. So the higher the inflation, the higher the interest rate. Okay, so this is what we need to know. All right. So let's move to some data. Okay, so as of the latest figure, all right, so as we can see, right, so the inflation, okay, so this is 2008, so the inflation once shot up to this close to 6%. So after that, the recession happened and the CPI data, okay, so falling. Okay, so now something similar happened. Okay, so as we can see, right, so due to the COVID, so the central bank stimulate economics, so printing too much money, QE policy, so causing the CPI shoot up, okay, hit about 8%. Okay, so recently, as we can see, right, because of the increase of interest rate, okay, so the inflation, okay, falling. Okay, so this is a very clear downtrend. Okay, so even though recently there's a spike, okay, so the inflation data slowly spike up. Okay, but basically this is still a clearly downtrend. Okay, as we can see last round, right, even though this is a falling, but it's not a straight fall. Okay, so you can see there's a small spike here. Okay, So another thing that we can look at, right, will be the interest rate. So this is the interest rate. Okay, so as you can see, right, the interest rate so increased dramatically to close to 6%. Now it's about 5.25 to 5.5. Okay, so basically just now we study about this thing, right? So interest rate trying to move same direction as inflation, but with lag. So basically, as we can see right now, what's happening? Okay, so the inflation is falling, okay, but the interest rate is still at relatively higher level. Okay, so is it mean that potentially the interest rate might be pause or maybe will be lower in the near future? Okay, basically for this part, right, so the room to go up further is a little bit smaller as compared to the downside. Okay, so as we can see, right, so recently what happening? Okay, so we back then about this March. Okay, so the interest rate is about 5%. Okay, so basically, right, you can see the upside. So for this past about 6 months, so it's quite small. Okay, so fine. After that, they increased another 25 basis point. Okay, after that, stagnant, pause, and increase another 25 basis point. And the coming tomorrow, okay, so will be another Federal Reserve FOMC meeting again. So very likely, based on the forecast, so we'll maintain the same rate. Okay, it's not going to hike another times. Okay, so basically, so meaning that the interest rate could be entering this part, so which is the pause. Okay, all right. So this is so far what happening right now. Okay, so after that, so we look at the equity market. Okay, so what happening to the equity market if let's say Federal Reserve go to cut the rate? All right. So basically, as we can see, right, so this is the forecast. So about interest rate. All right. So basically based on most of the forecast recently. Okay, so for the following 3 months, so 2023, so for the Federal Reserve to cut the rate, right, is a very slim chance. Okay, but very likely, so 2024. So you can see, right, so Federal Reserve very likely will cut the rate. Okay, so if let's say based on the table here, okay, so meaning that the chance that cut the rate as compared to hike rate further, so the cutting rate, the chances is higher. Okay, so basically, we need to look at this chart. So what if, okay, so Federal Reserve pause the rate or cut the rate, what will be happening for this equity market? Okay, as we can see here, right, so from the date last increase in a rate hike cycle, so meaning that this is a pause happened, the last rate hike. Okay, so this is the performance about the S&P 500. So from 1990 until today, so this is the historical data. Okay, so basically the last rate hike, right? So if let's say we go to look at will be July 26, so meaning about 2 months ago. So if let's say this time round they remain stagnant, and the following another 2 more round, so November and December, so they still maintain this 5.5%. So very likely that so the rate will enter into this pause section. Okay, so if let's say this really pause were to happen, right, so the following next quarter, as you can see, right, so the S&P 500, so the performance is close to about 7% return historically. Okay, so the next 6 months is about more than 10%. The next 12 months, so it's close to about 20%. So meaning that, right, once the Federal Reserve pause the rate, right, so the market, the equity market will start to react. Okay, so they don't wait until the rate cut really happen. Okay, so when we look at this subsequent rate cut, so let's say the first rate cut happening, what will be happen to this S&P 500, right? So for the next month, as you can see, right, so the performance is almost stagnant. So the next quarter with slightly negative, next 6 months, next 1 year. Okay, so the green color bar. Okay, so as we can see from here, right, so basically once the Federal Reserve confirm the rate cut, okay, so actually the equity market is not perform as good as the last rate hike. Okay, so basically this could be one of the things that we call buy on rumors and sell on fact. Okay, So before the Federal Reserve will to cut the rate, so the market will buy in. Okay. Once the Federal Reserve confirm there's a rate cut, and then the market will start selling. Okay. And just now we discussed, so basically in order for the Federal Reserve to cut the rate, right? Not necessarily is a good thing. Could be something is happening so that the Federal Reserve want to do some prevention or stimulate the economics. So that's why they cut the rate. All right. So this is what happened to the equity market. So basically, right? So don't wait until the rate cut. So if you want to do some building up of portfolio, construction of portfolio, right? So we should really look at the market recently. All right. So don't wait until the rate cut happen. Okay. So the rate cut happen not necessarily will benefit the equity market. All right. So after that, right, we will talk about bond market. Okay. So basically for today, I will be covering more about this bond market as compared to equity market, right? Actually, bond market is much more straightforward and much more sensitive to the interest rate. Okay. So basically for the interest rate and the bond, right, it's a very simple logic. Okay. So basically, if the interest rate goes up, raise, right? So what happened to the bond price? So basically the bond price will be falling and the yield will go up. Okay. Because basically very simple, which is, so let's assuming today, okay, so if the Federal Reserve were to raise the interest rate, so let's say 5%. Okay, so assuming 2020 you bought a bond. Okay, so the bond rate is only at 3%. So today the latest rate is 5%. Then of course, if let's say you want to sell to the market, so nobody want to take your 3% bond yield. Okay, so there will require a discount. Okay, and to match the current interest rate, which is 5%. So that's why basically bond performance, right? So in the interest rate hike cycle, right? So it's relatively weak. Okay, so it's not performing so well. Okay, so the interesting part will be, so when the interest rate falling, okay, so assuming, okay, so let's say back then about 2020, you have housing loan. Okay, so housing loan, assuming last time is about 1.5% is fixed for another 3 or 5 years. Okay, so when the interest rate goes up, right? So of course, nothing going to happen because you lock in the rate for 3 to 5 years at about 1.5%. Okay, it's very good deal, right? If let's say today we look back the interest rate and also the housing loan rate back then about 2020. Okay, so this same thing happened to the bond market. All right, so now the interest rate is very high. Okay, so the room to go up further is very limited, and the room to go down, right, will be much more higher. Okay, so right, so basically this is what is the thing that we need to know about bond. Okay, so if let's say the interest rate will to fall, right? So of course the bond price will goes up and the yield will fall. Assuming today you buy in a bond at a 5% bond yield. Okay, so let's say next year the Federal Reserve will to cut the rate. So back to let's say 3%, and you're holding a 5% bond yield. Okay, of course you will demand higher price if let's say you want to sell off this bond. Okay, so let's say you buy in $100, you can sell 103 or even 105. Okay, so this is a very simple logic. So interest rate goes up, so the bond price will fall. Okay, when the interest rate fall, right, so the bond price will go up and the yield will of course lower. So that's why basically now is a very good time that maybe you can consider to lock in at higher this bond yield. Okay, so you can maybe potentially to search for some bond. After that, if let's say you think that the bond yield is good enough, you can try to maybe lock in some of the yield at a relatively higher level. Okay, because nowadays most of the investment grade bond, right, able to give you minimally about 5% plus minus. Okay, so back then about 2 to 3 years back. Okay, so basically if let's say you want to lock in a 5% bond yield, right, it's quite difficult. So for investment grade bond, okay, so now is quite simple and quite a lot of choices in the market, so that this is one of the opportunity that is very rare opportunity. I think that is a very good timing that we can explore into this bond market. Okay, so basically is bond a good buy right now? Okay, so basically for this bond yield, right, as we can see, okay, just like I mentioned, so the bond yield is increased dramatically, okay, due to the Federal Reserve. So they hike the rate. So the company will to launch the bond, right, then need to launch at a higher rate so that to compensate. Because basically the Federal Reserve, what we so-called the no risk, the risk-free rate, right, is so high, so that they need to follow the rate to increase as well. Okay, so another things that we can take note, which is, so the bond right now is relatively at a fair price as compared to equity market, of course. Okay, so bond right now, right, is still able to find quite a fair bit of Sing dollar bond price at about $100 and also 5% bond yield. Okay, quite a lot of new bond launching recently, also about 5%. Okay, so basically this is one of the things that so we can export into, which is bond. Okay, so and just now we mentioned about this bond, right? So may offer attractive capital gain. So if let's say the interest rate go to cut in the near future, let's say next year 2024 or 2025. Okay, so at least the room for the interest rate to go up, right? So it's relatively smaller. Okay, the chances to go down, right, the interest rate is relatively higher. So that this might offer you this capital gain. Okay, so if let's say today you lock in the rate and 1 or 2 years later, okay, so you think that you don't want to hold anymore, okay, you want to sell it off, potentially you can sell at a higher price because the bond yield might be lower, okay, at that point of time. Okay, so if let's say you don't want to sell it off, you want to hold on, okay, you still can lock in at 5% for let's say the next 5 to 10 years. Okay, so you don't even need to bother or worry about the interest rate go down. Okay, the same concept applied. So it's like the housing loan rate back then. Okay, so you lock in the rate at lower rate, so the interest rate goes up, you no need to worry. And now you lock in at a higher rate, the bond yield. So even though the interest rate will go down, you no need to worry, because basically you already lock in at a higher bond yield. Okay, so this is about bond market. So basically we don't wait until the interest rate cut. Okay, so usually we buy during the pause. Okay, so if let's say now is a potentially pause. Okay, so now is a very good timing for you to lock in the rate. Okay, so when the interest rate really will to come down, right? So if you want to buy the new bond, okay, so some of the company might not issue new bond because they know that the interest rate will be lower in the near future. So if let's say they're able to wait, right, so they will wait and to launch at a better or lower rate. Okay, so usually if let's say now you think that some bond that the yield is good enough and you want to lock in, so basically right now is a very good timing to consider to lock in some. Okay, so this is the bond market. All right, so basically, right, so just now we cover about the good part about the bond market and the potential good factor. Okay, now so we will be exploring what is a fixed income, what is bond. Okay, what is the option that we have. Okay, so bond basically typically we can split into two different types. So one will be this government bond. Okay, so another one we can talk about will be the corporate bond. Okay, so government bond is relatively simple. So which is you go to ATM machine. So let's say there's a Singapore saving bond. So you use the ATM machine to subscribe. Okay, all right. So after that you want to sell off, you can sell off through the ATM machine. Okay, so this is relatively simple. So if let's say today you want to export something investment grade bond, is a corporate bond, let's say like maybe bank bond or CBC, DBS, or even some like Keppel Corp. Okay, so there's many corporate bond available in the market. Okay, so for this corporate bond, right, they will be starting at 250,000 one lot. So this is the initial launching price, 250,000. All right, so later on I will show you some example about this corporate bond. Okay, so after that, right, so why Phillip, as compared to some other financial institution, why choose Phillip? So basically, right, so for Phillip, so we offer 9 different currency globally. So basically we offer many different currencies bond. Okay, so if let's say today you want to find like USD bond, we have. So you want to find Sing dollar, or even you want to find some like maybe Aussie dollar. So basically we do have. Okay, so basically we also participate in both primary and secondary bond market globally. Okay, so meaning that, right, so let's say today you want to buy the new issue bond. Okay, so there's a recent bond HSBC launching, launched already, not launching, they launched already. So it's about 5+%. So this is the primary market. Okay, so you can buy first hand. Okay, so what if let's say you want to export something that maybe at a lower price. Okay, so you can look into this secondary bond market. So this is like an equity market. Similarly, we have the bond market. So this is a trader. So we can trade your bond. So in the secondary market. All right. So basically for Phillip, we offer both. You want to participate in the new launching or you want to trade in secondary bond market. So both we offer as well. Okay. And also we offer very competitive spread. So basically, if let's say you compare against some of the financial institution, so you compare our price and their price, right? Basically, you will see the differentiation. Let's say we offer like assuming $100. So maybe some financial institution that might offer, let's say 101 or 102. So this is so-called the spread. Okay. So it will be the profit that the financial institution they're earning. So this is the spread. So basically, we offer very competitive spread. Okay, so basically you can do the comparison between Phillip and also some financial institution. All right. So after that, right? So when we look at bond, okay, so very important thing will be the investment grade. Okay, some customer might worry that let's say what happened to the bond default. Okay, so usually when we really want to invest in bond, right? So the bond rating, the bond grading is very, very, very important. Okay. So especially in right now, the higher interest rate environment. Okay. So we don't really need to export into this non-investment grade bond because investment grade bond, right, can offer you relatively attractive bond yield at about 5-6%. So you don't really need to look into this non-investment grade. Because non-investment grade bond, right, also export to higher risk. Okay, so for the investment grade bond, so basically, as you can see, right, the highest quality will be AAA. Okay, all right. So this is offered by 3 different rating agency. All right. So if let's say you're worried, maybe you can potentially look into some very high quality this company bond. All right. So after that, right, so another thing that we need to take note will be the seniority ranking. So if let's say anything were to happen to the company, right? So how is the ranking that you can claim back the asset against the company? Okay, so basically for this kind of ranking, right? So we split into 2 different parts. So one will be secure, another one will be unsecure. Okay, so basically for this secure, right? So meaning that you will secure, you have certain claim on their asset. So could be like building or could be like maybe factory. Okay, so this is you have the particular asset to back. Okay, so another is so-called unsecured debt. Okay, unsecured debt meaning that you don't have any particular asset, but you can claim against their asset and cash flow. So in general, you can claim or if let's say there's any leftover after the liquidation. Okay, so this is the ranking. Okay, so basically right now most of the bond in the market, right, is categorized under this unsecured. Okay, because basically this secure nowadays, right, so most of the company is very unlikely to offer secure. Okay, so usually secure basically the company can pledge to the financial institution to get some funding. So that's why basically most of the bond in the market, right, is under this unsecured. Okay, so that's why just now we mentioned the rating is very important. So usually we need to choose a good quality company bond. So in order to lower down our risk. Okay. So after that, so this is some example that we can look into. Okay, so about the new bond. Okay, so basically just now we mentioned about let's say like HSBC, right? So usually if let's say you were to subscribe like maybe this new issue bond, right? So sometimes we receive this new launching in the early morning. So after that, right? So basically, so we will inform the customer so about this new bond. Okay, so let's say like for this HSBC bond. Okay, as you can see, right? So this is a fixed rate bond. So they're launching about 5.5%. So basically the final lending rate, right? So could be lower depending on the demand. Okay, so basically let's say for this bond the demand is high. Okay, so the rate will be lower. Okay, so this 5.5% is a guideline. Okay, so this is 10 years non-callable 5. So meaning that after 5 years they're only able to call back the bond if let's say HSBC want to redeem back. Okay, so this is how the new bond look like. Okay, only for 10 years. Okay, so another one will be Housing Development Board, HDB. Okay, so this is last year. So they're able to offer close to 4% and it's 7 years and senior bond. Okay, so basically, as I mentioned just now, so now you can explore and you can get a lot of good quality bond at a relatively attractive bond yield. Okay, so if let's say back then about 2 to 3 years back, okay, so if let's say we want to search for like, let's say 5 to 6% return, right? So for this kind of good quality bond, right? So usually the return is only about 3 to 4%. Okay, so right now you can easily get about 5% plus minus. So at a launching, so $100. Okay, so this is why I think that if let's say you want to export into some fixed income, right? So now is a quite rare opportunity that you might consider. Okay, so to build up your bond portfolio. Okay, so after that, so just now we're talking about this new issue bond, right? Because new issue bond, not necessarily you're able to get it, okay? Because basically we need to join the queue and we need to join the ballot. So end of the day, we'll be informing you that whether you get it or maybe you don't get it. You need to wait for next round, okay? So if let's say you want to straight away buy from the secondary market, okay? So basically POEM platform, okay? So you're able to search all this information, okay? So you log in the POEMs under this pricing level 1, okay? After that, you go to this bond tab, and then you can search for all the bond here, okay? So basically, assuming, so let's say you want to search for, let's say like a USD bond, and then you can select from the drop-down list here. So you select USD, then you show you all the USD bond. What is the option, okay? And similarly, Sing dollar. So this is what the Sing dollar bond available, okay? So some is even below par, so below $100. Okay, so basically this is what we call if the interest rate goes up, okay, so the bond price will adjust to the current level. So let's say right now the interest rate, so for most of the, let's say like some foreign bank, right, so they offer about 5%. So usually, so the market will adjust. Okay, so even though the secondary bond market, let's say last time they're launching at 3%, so the price will fall and to match the current rate 5%. Okay. So basically, so this is what you can search for. So if let's say you want to export and you want to know about the current market pricing and how is the current bond market look like. Okay, so basically all the information that you can get, right? So you can just log in and to search from here. Okay, so this is the over-the-counter bond. Okay, so assuming let's say today you want to place the order. Okay, so it's quite similar to the equity market. So basically, if let's say today you want to buy like let's say this UOB bank bond. Okay, so you can key in the indicative price. So let's say you want to buy at $100. Okay, so this is the indicative yield. Okay, so 3.5%. Let's say you were to buy at $100. So this is the yield that you get. Okay, so after that, so you confirm. So the trade amount will be 250,000. So the accrued interest. Okay, so basically what is this accrued interest about, right? So usually for bond, right, so they will pay on the semi-annual basis. So every 6 months, they will pay the bond yield. Let's say 3.5% coupon, right? They will pay every 6 months, okay? So basically, let's say today, the cutoff will be, let's say January. So after that, you'll be assuming July, okay? So let's say you buy in between, let's say you buy on March, okay? So you need to pay back so-called to the holder. So for this accrued interest for the past 2 months, because January they pay already, right? So for this February and March, these 2 months the interest, right? So you need to pay back to the seller. So after that you get this bond, and then on this July you will get back the one whole lump sum. So include this accrued interest. So basically this is how the accrued interest work. Okay. So after that, this is the total settlement amount. Okay. So after that, let's say you want to submit, you can key in the password and submit the order. Okay. So after that, this order, right, you route to the remisier or you route to the branch. So we'll call you confirmation. Okay. So basically, if let's say you want to inquire more about this bond, right? So basically, you can always maybe call into any of the branch or maybe call into your this dealer or remisier to understand more about this bond, how to do the placement. Okay. So this is how the over-the-counter bond market work. All right. So after we explore about this over-the-counter bond, right? So basically, because for this over-the-counter bond, right? So one lot is about 250,000. Okay. So maybe to some customer, they might think that this is too much. Okay. Because you need to put in this one lot 250,000. If that's assuming you want to diversify your risk, you don't want to too concentrate. Okay. So 250,000. Okay. So what you can consider, right? you can consider for another two different options. So one will be the unit trust, so it will be the bond fund or the money market fund. Okay, of course, there's still any other fund available. So, but today we mainly focus about bond fund and money market fund. Okay, so how this money market fund work, right? So, it's quite simple. So basically, for money market fund, right? So for Philip account, right? So if let's say you have this trading account with Philip and you opt in for this money market fund, right? So whatever ideal fund, right, in your account, so we will help you to park into this money market fund once you opt in into this money market fund. Okay, so this money market fund basically is considered a low risk, short-term place that to park your ideal fund. Let's say maybe you want to buy stock in the near future, or maybe you have some planning in the near future, you want to temporarily place that to park your fund, right? So this money market fund is one of the options that you can explore. Okay, so basically for this money market fund right now, so we offering, so it's about 2.7% per annum. So this rate is not fixed, it will be keep changing, but basically this is based on the market. Okay, so and also the USD, so this is the rate is about 3.1945% per annum. Okay, so basically, this is what you can consider to temporarily park your money into money market fund. Okay, so basically how money market fund work, right? We invest into some like government bond and also some like overnight borrowing. Okay, so this is a very short-term instrument that we invest into, so that we provide you this return. Okay, so basically this is how money market fund work. Okay, so if you want to know more, right, so feel free to call us so that we will explain to you further about how this money market fund work. Okay, so after that, so we export into this bond fund. So how the bond fund work, right? So as compared to money market fund, okay, so as you can see from here, right? So money market fund will be relatively lower risk because basically they only part into some like government bond and also some like bank deposit, so which is very short duration. So that's why basically it's also very short, very low risk instrument. Okay, but let's say today you want to export something higher. Okay, so basically you'll be bond fund. Okay, because money market fund, right, is not something that you can benefit from the falling of interest rate. Okay, because basically if let's say interest rate go to cut, right, so the money market fund, the rate will come down as well because they only mainly invest into very short-term duration. Okay, so it's very short-term, like maybe the overnight borrowing and also very short-term government bond. Okay, so that basically if the interest rate were to cut, so this money market fund rate will auto adjust back to the current level. Okay, so if let's say you want to export into the interest rate, okay, so let's say you want like maybe interest rate fall and you want to potentially benefit, what you can export, right? And if let's say you do want a single corporate bond, you can export into a unit trust. Okay, so this is one of the example that I screenshot about a pure bond fund. So this is a 100% bond fund. Okay, so as you can see from here, right, so the pricing for bond fund, right, is relatively stable. So this is about 2 months. Okay, so 2 to 3 months of price movement. Okay, so basically you can see, right, so the pricing, so 8.51. Okay, so every daily the pricing movement, right, so as compared to some of the equity fund or some of the high risk fund, right, so the bond pricing, as you can see, right, is relatively stable. Okay, so this is the net asset value. Okay, so other than the pricing, right, the potential capital appreciation, so what you can get, right, will be the potential dividend payout. Okay, so basically for most of the bond fund, right, so they will pay on the monthly basis for the dividend payout. Okay, so basically the dividend, as you can see, right, so at the very beginning, so they only pay 0.034033 dividend yield, this dividend per unit. Okay, so after that, right, you can see recently, okay, so last year, so they increased the rate to higher. Okay, because very simple, because the interest rate keep going up, so the new bond that they buy in, right, they can get at a higher dividend yield, so that they will pay you higher yield. So assuming, let's say today on the 28th October, you hold this bond, right, so you hold for 1 month. Okay, so basically you get one-time dividend payout. Okay, so 1 month later, right, so the price is still about the same, but you get the dividend payout, and then you hold for another month again. Okay, so basically you get another month dividend payout, and the price is about the same. Okay, so basically this is how the bond fund work. Okay, so basically, of course, this still subject to the market fluctuation. So this is not guaranteed. So all the examples shown here, right? So it just based on the historical. So basically, if you don't want to export too much risk into a single corporate bond, so this is some other option that you can export into, like a pure bond fund. Okay, so basically for pure bond fund, right, there's many different type of pure bond. So just now we mentioned about bond, right? So there's some higher risk bond will be what we so-called this non-investment grade and some investment grade. So when we look at the fund itself, right? So if let's say you want a relatively stable, okay, so you look into a unit trust, the fund that offer you investment grade. Okay, so basically most of the bond fund, right? So they will tell you what is the bond grading that they're able to invest into. Okay, so if let's say you want a relatively stable bond fund, then you look at the investment grade. Okay, so you only find the investment grade bond fund. Okay, but if let's say you want to get a very high return from the bond, okay, so basically you can look at this on non-investment grade bond. But of course, non-investment grade bond also subject to higher risk. Okay, so basically right now, based on the market, right, most of the investment grade bond unit trust, right, so is able to offer close to about 5%, 5.5 to 5% around there. Okay, so the non-investment grade bond, of course, they're able to offer higher, but also subject to the capital appreciation or depreciation. Okay, because basically non-investment grade bond, right, the pricing fluctuation is relatively higher. So it's not as stable as the investment grade. Okay, so basically this is a very important thing that let's say you want to select a bond, then we need to look at the bond rating. Okay, so after that it will be one of the another things that we can look at will be the balance fund. So some customer that might want to explore a little bit more, so that they want to go into only pure bond, so they want to go into equity and bond as well, so both combined together. Okay, so basically, right, so you can export into will be the balance fund. Okay, so basically balance fund meaning that some of the unit trust, right, so they invest into 50-50%. So 50 into equity and 50 into bond, so that you can enjoy the best of both worlds. Okay, so the equity and also the bond. And some fund they will do the rebalancing accordingly, according to the market. Okay, so let's say right now the market is good towards the bond, so the fund manager might increase the bond holdings and reduce the equity holdings and vice versa. Okay, so basically this is how the balance fund work. Okay, so basically if let's say you were to go into balance fund, right, of course some of the balance fund, right, so the dividend payout will be slightly lower, because basically some they invest into the equity, right, because the equity is more about capital appreciation. Okay, so the dividend payout might not be as high as the bond. Okay, so if let's say you're looking for high dividend yield, you can go into pure bond. But if let's say you want to participate in capital gain as well as dividend payout, then you can export into this balance fund. Okay, so this is how so-called the bond market that you can export into. So basically you can wire the direct investment, which is a government bond or the corporate bond. Okay, so you just buy directly. So government bond will be through the ATM machine, and corporate bond will be you can via our this Poyum platform. So either will be the primary or the secondary market. Okay, so if you think one single lot of bond is too much, you can export into maybe unit trust. Okay, so basically unit trust you can go into like money market fund, bond fund, or even balance fund. Okay, so all these three funds, right, they have exposure into the bond market. Okay, so basically this is how the bond market work. All right, so today's summary. So basically, right, so based on my opinion, so I think that bond now is relatively attractive as compared to equity market, because basically equity market, as you can see, start from 2022 end of the year until now, right? So the market is really go up quite a fair bit. But as compared to the bond market, okay, most of the bond, the pricing is still relatively stable. Okay, not much movement because the interest rate is still at the higher level. So that this creates the opportunity for you, right? So to slowly build up your bond portfolio. Okay, so as just now we mentioned, right? So there's always a lag. So when you see the CPI or the inflation come down, right? So the interest rate so might not come down straight away. So there will be a pause for a while. Okay, so the Federal Reserve ensure that the inflation is confirmed, able to go down further, so they will start to cut the rate. So that's why this is one of the opportunity or is the things that we can take note. Okay, so before the rate cut, we can start to build some bond portfolio. Okay, so let me see what else I can cover. All right. So basically that's about it. So for today presentation. So now we will enter into this Q&A section. So if let's say you have any things that you need to ask, right? So feel free to type in the chat box. So basically I will be answering some of the Q&A. So okay. Okay, so Joe asking, so can SRS fund be used for bond fund? All right, so basically for SRS fund, you can go for bond fund. Quite a lot of bond fund is available using these SRS options. So basically, there's quite a lot of bond fund in the market. Okay, so basically, if let's say you want me to name a particular fund, right? Cause due to some term and this PNC, so I couldn't tell you the name about the fund itself. But basically, right, you can just go to our Poyum web, this platform. So after that, from there, right, you can search about this SRS available this unit trust. Okay, so basically, if let's say you want to know more about the particular unit trust, okay, you want to know about the name or about the recommendation, okay, so feel free to drop us the email or you can call me. So basically, I will maybe explore more and give you a recommendation personally, okay. So after that, Lee, so to confirm, okay, so minimum amount needed to invest in Poyum's global bond fund and over-the-counter bond. So what are their highest indicative yield and dividend yield? Okay, so basically, if let's say you want to invest in this global bond fund, okay, so usually for global bond fund, you're talking about is unit trust, okay, so basically most of the unit trust, right, so the minimum investment amount is only $1,000, okay, so some higher, some lower, but usually it's about $1,000 minimum, okay, so and over the counter bond, right, so over the counter bond meaning is the corporate bond, okay, so corporate bond one lot, if let's say you buy at the launching, okay, so it's 250,000 one lot, unless some bond they fall below their this launching price, okay, so the par value, then maybe you able to get lower. But usually we talk about one lot is 250,000 for this over-the-counter bond, okay. So the highest indicative yield or dividend yield, right? So if let's say based on right now the market, so the highest can be very high. So if you go for like maybe the non-investment grade bond, okay, so if let's say we're talking about the investment grade, so generally, okay, it's about 5% plus minus generally, okay, so if let's say too high that the fund or the bond able to offer, right, then will be a little bit risky lah, okay. So hope I answer your questions. So is Asia investment grade bond fund attractive now? Basically, most of the investment grade bond right now, right? My personal view that is quite attractive. Okay, so given the dividend yield, okay, so it's quite attractive. But the particular fund that you mentioned about, right? So I don't know which fund. Then we need to explore into what is the holdings that they have. Okay, but basically in general, so all the investment grade bond, regardless in Asia or globally, so it's quite attractive right now. Okay, so after that, retail bond are available on your platform. So what is the coupon rate on this retail bond? Okay, so basically, retail bond, I believe you're talking about, is it a corporate bond? Okay, so basically we do offer the retail corporate bond. Okay, so basically retail corporate bond, like just now I mentioned, it'll be 250,000 one lot. Okay, so the coupon will be depend on the particular company. Okay, so some company, let's say like bank, so let's say overseas bank, so they will offer higher, about 5% to 5.5. And some, let's say like local bank, right? So local bank, usually they're trying to offer lower, let's say like maybe 4 to 4.5 plus minus, depend whether it's fixed maturity or perpetual bond. Usually perpetual bond will be a higher rate. Okay, so if let's say a fixed maturity bond, usually they will offer slightly lower rate. Okay, so basically yes, we do have retail bond. So if let's say you're talking about like the government bond, okay, so the government some of the government bond, okay, so some of the government retail bond, right, you can trade via our platform, but basically the charges is a little bit higher. So I will suggest you maybe you can consider to use the ATM machine to do the buy and sell. Okay, so if let's say you're talking about like the $1,000 subscription, the retail bond. Okay, so the one is better you use the ATM machine because basically you're able to use Poyum platform to trade, but the cost will be slightly higher. Okay, so the best will be use our platform to trade the corporate bond. Okay, because corporate bond you cannot access via the ATM machine. Okay. Okay. So Cheng Xiang asking about bond fund unit trust versus bond ETF. So which one is better? Okay. So basically both have their own benefit. All right. So basically bond fund unit trust, right? So most of the bond fund unit trust, okay, so it's active managed. So meaning that the fund manager, so they will based on the market economics status or the entire global market. So to do the decision whether they want to buy or they want to sell. Okay, so there will be an active manage. Okay, so whereas this a bond ETF, right? So it will be passive. So meaning that they only track like maybe global bond index or maybe a certain bond index. Okay, so basically that will be a passive manage regardless the market performance. So they will track the same index or same group of bond. Okay, so let's say like global bond. Okay, so basically this is depend whether you believe in active management or passive management. Okay, so some very good or maybe very outstanding fund manager, right? So they manage the bond fund very well. Okay, so let's say during the market downturn, right? So they will switch some of the holdings, so maybe from risky to slightly defensive. Okay, so this is the good part about unit trust. But of course, the cost will be relatively higher as compared to ETF. Okay, so most of the so-called the bond fund manager, right, they'll be charging a management fees range for maybe 0.7 to 1.5%. So this is the differentiation. Okay, so both have their own benefit. Okay, so depend. Okay, so this really depend. So if let's say you're able to find a good bond fund manager, then of course this unit trust you outperform the ETF. Okay, so depend on the underlying fund. All right, so after that, okay, so Lee asking about the cost and charges involved investing in these bonds and unit trust. Okay, so basically unit trust, if let's say you don't need our advisory, so you trade directly via Poyum platform. Okay, you buy sell through our Poyum platform. So basically for Philip, right, so we don't charge any seal charge. So usually if let's say you download the fact sheet, right, you look at the seal charge. So the seal charge is indicate about maybe 3 to 5% range. So some bank they will be charging about 3 to 5%. But if you today you use our Poyum platform, you do DIY, you buy sell yourself, basically we don't charge. So it'll be 0% for seal charge. Okay. So but if let's say today you need our advisory, so you don't know what to buy, so you want to maybe build our portfolio. Because basically we providing is a portfolio building up service. We don't really suggest or give you advisory about single fund because single fund is no meaning. We want to help to build up a portfolio. Okay. So basically this service we charge a fees. So it's 1.5%. So flat rate. So basically we will be give you update about the market and also we how to do regular rebalancing. Okay. So this is a portfolio construction service for unit trust. Okay. So let's say for the corporate bond that you're talking about, right? So this corporate bond we charge will be a spread. So the spread is 0.25%. Okay. So 25 basis point. Okay, so basically, if you compare to some of the financial institution, right? So usually they charge quite high for bond. So basically, if you were to compare, right? So honestly speaking, so our bond, our corporate bond is very, very competitive, our pricing. Okay, because some bank they even charge maybe $1 or $2 for the spread. Okay, but we only charge 25 basis point. Okay, basically for the bond, right, if let's say you buy a primary market, Okay, so we will give you maybe our opinion, so whether this bond is good or not so good to go in. Okay, so basically bond, you can always consult us. Okay, so let's say you want to know more about bond, right? So feel free to call me or maybe drop us an email. So after that, right, so we can discuss further about corporate bond or even unit trust. Let's say you got anything you want to ask about, right? So basically, we can discuss privately. Because basically, we cannot give you a direct recommendation about which fund is go in. Okay, because all will be based on your profile. Okay, so some customer can take higher risk, and some customer is relatively defensive. So basically, we'll based on your risk profile to give you a recommendation accordingly. Okay. Okay, after that, let's see what's the next question. Okay, so Lee asked about minimum investment needed to invest in portfolio fund at POEMS. Okay, so basically, if you're talking about unit trust portfolio, right? So we don't have any minimum. So the fund minimum is only $1,000. Okay, so after that, the subsequent investment can be 100. Okay, so basically, the minimum is $1,000 only for one underlying fund. So let's say today you want to buy in, let's say fund A. Okay, so it'll be the minimum $1,000. Okay, so after that, subsequent investment is $100. Okay, so depend on the fund itself. Some fund they require higher, but most of the fund generally is about $1,000 minimum. Okay, so that you can diversify. Okay, so basically maybe you have, let's say, like assuming $10,000 or maybe 100,000. So you no need to invest into single fund. Okay, so we can invest into a few fund, let's say 2 to 3 fund. Okay, so some like maybe you want to invest in investment grade bond, and some you want to invest into balance fund, and some maybe you want to invest into maybe like a global bond, or maybe a global equity. Okay, so basically this is how we plan for the portfolio. Okay, so basically don't maybe put all your egg under one basket. So we always believe in diversification. Okay, so bond is good. Of course, you can explore into some maybe other equity fund as well. Okay, so hope I answer your questions. Okay, so we still have another 7 minutes more. So if you have any more questions, so feel free to type in the chat box. So I will try my best to answer your question. Okay, so and other than that, right? So while waiting for the questions, so maybe we can share a little bit more about this money market fund. So basically, so some customer they don't really know how to invest in bond market. So they might be worried about this bond market volatility. So if let's say you want something safer, all right, so this is what just now we talking about the money market fund, right? So this is a very, very good so-called the short-term instrument that you can park your fund into, okay? As compared to some of the bank current so-called the interest rate, right? So basically, some even bank saving account or even some like maybe very short-term investment, right? So basically, so this money market fund, right, offering is very competitive yield, even though this is non-guaranteed, okay? But basically based on the historical in the past 20 years, right? So for this money market fund, right, so basically there's no default, okay? So we're able to achieve a very good return based on the past 20 years, especially right now it's a relatively higher interest rate environment, okay? So last month, so we do have this 5.8%. So promotion for this money market fund, but it's really over. But right now we're still offering this 2.77% per annum. Okay, so for this money market fund. Okay, so if you have any spare fund and you don't know park to where, right? So don't park in your saving account. So you can consider maybe to park a little bit into this money market fund. Okay, so this money market fund is what we so-called the short-term instrument that you can park into to enjoy some return. Okay, so if let's say maybe once you want to maybe invest into the stock market and you found some opportunity, or maybe you think something better, you can always withdraw out. Okay, so this is if let's say you withdraw before 10 a.m., right? So this fund will reach your bank account. So on the same day. Okay, so if let's say you withdraw before 10 a.m. early morning. Okay, so this is how money market fund work. Okay, so this is also one of the very good instrument that you can explore. So if let's say you have some spare cash and you don't know where the money you want to park to. Okay, so this is a temporary place that you can park to money market fund. Okay. All right, so we have the new questions. Okay, so Cheng Xiang asked about, so is the Austria PE bond 4.125% available on your platform? How about the 3.0% 50 years Singapore government green bond? Understand both are minimum $1,000 per lot. Okay, so basically for these two bond, right, if I remember correctly, both you can trade under our Poyum platform. You can search about these two bond. I believe you're able to trade using our platform. And just now I mentioned, so basically if let's say you want to trade these two bond using our platform, right, so the charges will be a little bit higher. So we can consult the dealer or the remisier about the charges. But I remember correctly, it will be not so worth it lah. Okay, so it's better if let's say you want to trade this bond, right? It's better you use the ATM machine to do the buy sell. Okay, or you through the bank to do the buy sell. Okay, basically you're able to use our platform to trade. Okay. So Joe asked about in this smart park. Yes, correct. So this is our smart park. Okay, so basically smart park is our marketing name. So basically the smart park, right? So it's parked into money market fund. Okay, so there's many money market fund available in the market, but the good about this Philip money market fund, right, is liquidity. Okay, so we can withdraw within the same day. Okay, in the market, I believe a lot of money market fund, right, not able to do so. Okay, so you need to wait about few days for the money to reach your bank account. Okay, but for our Philip money market fund, the smart part, right, so you can withdraw or you can utilize the fund within the same day. As long as you submit before 10 a.m. early morning. Okay. Okay. So one client asked about, you mentioned no fees buying unit trust. So if I buy from other institution, is the price the same or you have already factored in the fees in your price? Okay, so basically for unit trust, right, so this is so-called net asset value. So the net asset value will be the same across all the platform. Okay, so you don't see different pricing across different platform. So basically with the same pricing. So we don't embed any additional price into the net asset value that you see. Okay, so basically we don't charge, still charge, and also the pricing that you see in our platform, right, and also other platform, right, will be the same. Okay, so the net asset value will be the same. Okay, so basically rest assured that so we don't charge you any like still charge. Okay, so basically no need to worry about this. Okay, so you will get the same pricing. You buy using our platform or even use other platform, right? So it'll be the same net asset value. Okay, but just that maybe most of the other financial institution they charge you the still charge. Okay, so but our platform because DIY, so you do it yourself. Okay, so basically we don't charge the still charge. Okay. All right, so if let's say no further questions, so we will end our webinar right here. So all right, so thank you for joining today's webinar. All right, so have a good day. So bye-bye.